Hello and welcome. I wanted to do a quick video introducing my dividend growth portfolio. So with this portfolio, I started it back in September and I've been investing in it ever since. It's currently just a small portfolio in the grand scheme of my total investments. It's not even 10% of my net worth currently. And while I do expect it to grow, I don't expect it to be the majority of my investments in the future. I am mainly investing in this to satisfy my stock picking itch and to focus on dividends. So just looking at the portfolio real quick, I have about $12,797 invested. I'm currently auto investing $100 every week. So far, the portfolio has gained $1,279.92, or a 22.19% return. Of that total gain, $1,175 has been market gains, and $104 have been earned dividends. The intent of my dividend growth portfolio is to invest for dividends, so the over $1,000 of market gains is really just the cherry on top, right? I want dividends coming in so that I can right now reinvest them to buy more shares of these stocks, but in the future I want to be able to use the dividends as monthly income to pay bills and to provide a passive income cushion so that, if anything happens down the line, I lose my job or an unexpected expense come up, I have these dividends to help pay for those, right? And the ultimate goal is to get to a point to where the dividends from this dividend growth portfolio and my other investments can pay for my lifestyle so that I can be financially independent. So before I deep dive into this portfolio, I'll go ahead and mention that before I started this portfolio, I was really only investing in 3 funds across my various investment vehicles. So whether it was my brokerage accounts or my 401k with my company or my IRAs or health savings accounts, I was only investing really in S&P 500 index funds, total stock market index funds, or foreign total stock market index funds. So those were the 3 funds I was investing in. Typically Vanguard funds, if those were available to me. I have brokerage accounts with Vanguard. But then I started this portfolio to add some extra diversification away from those funds, which you will see below, and to focus more on dividends and to satisfy my stock picking itch. I like to research companies and learn about them. I use M1 Finance as my brokerage for this portfolio. I feel like M1 is tailored towards long-term investors, even long-term dividend investors, and their features kind of reflect that. And I really like their auto invest feature, where whenever I have more than $25 in cash balance, it just goes ahead and invests it according to my target allocations to try to bring the total allocation back into my target. So starting to go through the portfolio, some basic M1 terminology is my dividend growth portfolio is a pie. Pies are how portfolios are structured in M1, and pies are made up of slices, and slices can be their own pies, which are made up of slices, or they can be individual holdings like stocks or ETFs. I have chosen to create my own pie. However, you can choose to model your pie off of somebody else's if they give you a link, or you can choose from some preset pies that M1 provides. These could be basic pies that are set up for different investment strategies from conservative to aggressive. They can be pies that mirror different hedge funds. For example, you could invest in a Berkshire Hathaway pie that mirrors Berkshire Hathaway's investments to the best of its abilities, and some other pies. But I've chosen to set up my own, and I set up my pie to have slices that are based off the sectors of the economy. That way I can easily tell how much I have as an allocation towards each sector, and it makes it easier to find companies if I'm going through these slices and I want to make edits. So as I said before, right, that I invest heavily in S&P 500 index funds and total stock market index funds, and those are very tech heavy and they don't have a lot of real estate exposure. So tech is a very small target allocation in this pie, and real estate is actually my largest slice. So my first slice here, real estate, is 24% target allocation, has $3,000 in it right now, and it's up 37%. So looking at this slice, I have market gains of $468, and I have earned dividends of $26.59. So real estate is my highest paying slice, one, because it has the most money in it, but also because it has the highest dividend yield out of all of my slices. So looking at the companies that I have in this slice, I have Store Capital, I have Federal Realty, I have Essex Property Trust, Realty Income, Gladstone Land, and Stag Industrial. These are all what are known as REITs, Real Estate Investment Trusts. Real estate investment trusts are a certain type of organization. REITs, while like stocks, are required to pay a certain amount of their income as dividends, and if they meet these requirements of a REIT, they don't get taxed. Instead, their dividends get taxed. So it's just a special type of stock entity. Some REITs, like these bottom three, Realty Income Corp, Gladstone, and Stag, they actually pay monthly dividends. So they provide nice, stable monthly dividends. Realty Income has been increasing its dividends for over 25 years. It's what's known as a Dividend Aristocrat. Dividend Aristocrats are typically companies that are in the S&P 500, and they've increased their dividend for 25 years. Not paid dividends for 25 years. They have done that, but they have continually increased it year over year. Dividend Aristocrats are the backbone of my dividend growth portfolio. A lot of Dividend Aristocrats are the companies I invest in. I don't invest in every Dividend Aristocrat, and I also invest in some companies that are not Dividend Aristocrats. If you're just looking to invest in Dividend Aristocrats, I suggest you check out the NOBL ETF, NOBL. So moving on from this slice and looking at my next, I have utilities at 16% target allocation, has $2,000 in it, and utilities have been pretty flat since I've been investing in them. So utilities are another sector of the economy that pays high dividends. So as you can see, my total gain here is only $4.79. Like I've said, utilities have been pretty flat since I've been investing in them. They're very stable, they do offer some growth, and they offer dividends. Utilities usually grow with the economy, and you're not going to get amazing outperformance. However, if you notice for this slice, my market gain is actually a loss of $16.44, but that's made up by my earned dividends of $21.23. If these companies didn't pay dividends, I would actually be at a loss right now. However, the dividends are a gain, and since the prices have been going down, hence the loss, the dividends have been buying the shares at lower and lower prices, which is increasing my yield on cost, so the amount of dividends I'm getting paid per dollar invested, and their dollar cost averaging into the stocks. So I'm not too concerned about the everyday ups and downs of the market from week to week. I'm more interested in owning more shares of the company and getting paid more in dividends. The market can go up and down, but typically the dividends are set yearly by the company, and most companies increase them year over year. So in this slice, I have Alliant Energy Corp. I have American Electric Power, Southern Company, Duke, Dominion, and Atmos. And some of these have been down the past few weeks, and I've just been dollar cost averaging through M1's Auto Invest feature and picking them up for lower share prices. So moving on from the utilities slice, my next one is healthcare. Healthcare is set at 10% for a target allocation. Currently have around $1,200 in it. A market gain of $45.68, and I've earned $9.90 in dividends. So the stocks I invest in this slice are AbbVie, which is my largest holding and has done pretty well, Cardinal Health, Pfizer, Medtronic, Johnson & Johnson, Merck, Abbott Laboratories, Becton, Dixon & Company, and Viatris. Viatris is only a 2% target allocation. I actually didn't invest in Viatris. It was spun off from Pfizer, and so I got so many shares of Viatris based off how many shares of Pfizer I've owned. I don't know if I'll keep this in my portfolio long term or not. I'm waiting until there's more information available on the company. It hasn't started paying a dividend yet, so I'm going to wait until I learn about what its dividend is going to be. Also, this gain return number here is not quite correct because I received these shares from the spinoff and I didn't actually buy them, so my cost basis is a little wonky. So this isn't a true representation of my return on this stock. Once I have more information on it, I'll determine if I want to keep it or not. And if I do, then I'll update my target allocations based off how confidently I feel in Viatris's future. So that concludes the healthcare sector. Moving on to the next sector, the next slice is communications. Communications has done pretty well. I have about $1,200 in it. It has a market gain of $75.61 and $11.22 in earned dividends. I only have 4 companies in this slice, and those are AT&T and Verizon. And I view AT&T and Verizon as a duopoly. It's true that T-Mobile is starting to increase in market share, but predominantly telecommunications has been dominated by AT&T and Verizon. And I like to invest in both sides of a duopoly because you don't always know which one is going to do better. And sometimes one will do better and it will outperform, and then the other stock, which hasn't been doing as well, will then start to outperform. So I like to invest in both sides instead of just choosing one. You'll see that several times throughout my portfolio. Coke and Pepsi is another one I can think of. Home Depot and Lowe's. So AT&T and Verizon both have target allocations of 39%. Next I have Comcast Corp, and then I have Disney. So Disney doesn't really fit in to my investing philosophy for this portfolio right now. Disney suspended its dividend back in 2020 due to the pandemic, and so its share price suffered as a result of that and due to the closing of the parks. I've been investing in Disney because I think that when the parks reopen and the pandemic settles down, they will start paying their dividend again. But until then, I'm only keeping them at a 5% target allocation. But they've done really well, right? They have Disney Plus providing growth to the company. The parks are going to be reopening. So they've been my top gainer in my communication slice. I don't expect them to go anywhere. Even though they're not paying a dividend yet, I expect they'll put it back, and then I'll reevaluate where they should be in this portfolio. Probably I will increase the target allocation. Moving on to the next slice, we have finance. Finance has done pretty well. I have a target allocation of 9%. I think that people thought finance was going to do worse in the pandemic than it did. It fell, and it's been a solid recovery story since then. So in finance, I have around $1,100 invested. I have a 47% total return. Market gains are $208. Earned dividends are $6.30. And I'm investing in T. Rowe Price, J.P. Morgan, Aflac, U.S. Bancorp, BlackRock, Moody's, S&P Global. This is another duopoly that I invest in. Moody's and S&P Global are competing companies, and together they own the vast majority of the market share in analytics and credit ratings and benchmarks. I'd mentioned the S&P 500. S&P Global is the one that makes that benchmark. Also the Dividend Aristocrats Index. I also invest in Cincinnati Financial and People's United Financial. People's United is by far my top gainer in this slice, and part of that is due to recent news that they are going to be acquired by another bank, and so their share price quickly shot up. After it's acquired, I don't know if I will keep the new company in my portfolio or not. I haven't done that research yet. I'm going to wait till I see if the transaction actually does happen. So another slice is my industrial slice. It's at an 8% target allocation. I believe that the industrial slice is my largest slice in terms of companies in it. And the industrial sector is the largest sector by weight in the Dividend Aristocrats Index as well. So there are a lot of Dividend Aristocrats in the industrial sector. So far, this slice has returned 30%, $125 of market gain, $5.61 of earned dividends. The companies I invest in are Snap-on, Waste Management, A.O. Smith Corp., 3M, Carlisle Companies, Raytheon Technologies, Cintas Corporation, Dover, Carrier Global, Caterpillar, Otis, Illinois Tool Works, General Dynamics, Stanley Black & Decker, W.W. Grainger, and Roper Technologies. So in the future, I could see me upping the allocation of the industrial slice because I have so many companies invested in here that these companies tend to be smaller holdings individually in my total portfolio than some of my other companies because of how many are in this sector. Moving on to consumer staples. This is a 7% target allocation. I only have $885 in consumer staples. I have a market gain of $19.83 and earned dividends of $8.64. So a lot of my total gain here has been from earned dividends. So here I'm investing in Costco, Coca-Cola, Altria, PepsiCo, see another duopoly, Coca-Cola and Pepsi, Tyson Foods, Archer Daniels Midland, Hormel Foods, McCormick, Procter & Gamble, Clorox, Brown-Forman, Walgreens, Kimberly-Clark, and Walmart. So the consumer sectors of the economy have a lot more household brand names. My largest holding in this slice is Costco. I think Costco is a high quality company, and so it typically trades at a high multiple. Costco has pulled back recently, and so I've been purchasing more and more Costco. Costco is one of those companies, it's the triple threat. It provides value to investors, it provides value to its employees, and it provides values to its customers. Very few companies provide value to all three of those stakeholders. So I think Costco is a great company. It's going to continue to do well in the future, and I want to own more of it, and I love the fact that it's pulled back recently, allowing me to get in at a better price. Moving on to the next consumer sector, consumer discretionary. This also has a target allocation of 7%. And the consumer discretionary sector of the economy is much more spread out, has more variety, I think, in the businesses that make it up. I have a market gain of $66.66 and earned dividends of $5.21, a total return of 17.51%. So looking at the companies that makes up this slice, I have Toyota, I have Home Depot, I have Leggett & Platt, Starbucks, Genuine Parts, Lowe's, right? That's another duopoly I invest in, Home Depot and Lowe's. If I would have had to have chose just one of those to invest in, I probably would have chose Home Depot. But Lowe's has been the better performer recently, and that's why I like to invest in these duopolies. I don't know which one's going to do better, but if I invest in both, I'll get the growth that their market has, right? Whether it's Home Depot that captures it or Lowe's, I'm still seeing that growth. Then I have Target and I have McDonald's. So this sector of the economy does anything from car manufacturing and home improvement stores to fast food like Starbucks and McDonald's to retail. So it's a varied part of the economy. So I would also like to look at Toyota Motor here. It's a unique case for stock investors. Toyota has this ADR by it, and ADR means American Depository Receipt, and ADRs are basically companies, foreign companies, that are being bought and sold and traded on American exchanges through this ADR. Although Toyota is a Japanese company, it's being traded on American exchanges in American dollars. There is some unique tax stuff here, but it's being handled for you. So when Toyota pays a dividend, let's just use a hypothetical amount here. Say it pays $1 in dividends. You might only get 90 cents of that. 10 cents would be the foreign tax on that. So if you see negative dividends and you're wondering what's going on, it's probably that the company that paid the dividend is an ADR. So if you do run into that, that's probably what's going on there. Home Depot will be my largest holding. I have a 17% target allocation on that. It's growing its dividend really fast, and that's what I like to see and invest in. Moving on to the next slice, I have technology, right? So I've mentioned before that I invest in the total stock market index, and I invest in the S&P 500 index. Those are very tech heavy, and so I believe that my investments as a whole has at least 20% in technology. So I didn't want much technology in this portfolio, but I still want exposure to those companies in the tech sector that are doing really good and growing their dividends or pay a decent dividend. So looking at my technology slice, technology companies, if they do pay dividends, typically don't pay very high dividends. So my earned dividends for this is only $2.40. Some of my smaller slices actually pay more dividends than this, but I have a 17.4% total return, so that's not too bad. The companies I invest here in are Apple and Microsoft, Texas Instruments, MasterCard, and Visa. Again, another duopoly that I invest in. If I would have chose one, I would have chose Visa, but MasterCard has actually been outperforming Visa recently. ADP, Automatic Data Processing, and Intel. Tech has recently had a tech sell-off, so if we look at Apple here, currently in this slice, it is my lowest gaining stock. However, at one point, it was by far the highest gaining stock. So the price has gone up, it's gone down, it's gone back up, it's gone down. Recently, it's sold off, but it still pays the same amount or more in dividends than when I bought it. Same with Microsoft. It's gone up, it's gone down, but it still pays at least the same amount in dividends or more. In fact, Microsoft, I know, recently increased their dividend by 10%. I believe that was around the December timeframe. So the dividends are growing whether the stock price goes up or it goes down, and so that's why I'm investing in dividends. They're more stable than the stock price. Moving on to my next slice, I have energy. So energy is probably my smallest slice in terms of companies invested. I only have ExxonMobil and Chevron. These are oil companies. Oil companies were, really down in the dumps after the pandemic, but they've since recovered somewhat. Oil is a messy sector, right? There's a lot of companies, some of them aren't very good, but I believe that ExxonMobil and Chevron, they have the balance sheets and they're in the best position to weather whatever happens in the next year or the next 5 years. And so they've done very well recovering from the pandemic. Exxon is up over 100%, 128%. Chevron is up nearly 70%. And they pay very good dividends. They have high dividend yields, especially back when I bought them in September. They had really high yields. I believe ExxonMobil was in the double digits back then. So I have a very high yield on cost in these companies to go along with my capital gains. So I have earned dividends of $6.79. That's actually more than the tech sector, even though I have more money invested in the tech sector. And this total return of 96% is amazing, especially for energy companies. Next, we have my final slice. My final slice is materials. And materials is a recent addition to my pie. I haven't quite fully evaluated where these companies will fit in and how much money I want allocated to them, but I knew I wanted some exposure to this sector, so I created a materials slice and I added in Dividend Aristocrats from the materials sector. So I have Amcor, Sherwin-Williams, PPG Industries, Albemarle, and Ecolab. Albemarle has done extremely well. It's a benefactor of EV hype. They mine lithium, and so they've been growing with other EV related companies this year. This is a pretty small slice. I only have $184 invested currently in this slice. Market gain is $5.56. Earned dividends is only 68 cents. And I haven't quite determined how I want this slice to be allocated yet. The target allocation is 20% all the way down. That might change as I do more research into these companies. So if we look at my holdings as a whole, they kind of reflect my slices, right? My top holdings are real estate companies, telecommunication companies, and utility companies. I currently have 86 positions, right? And my top holdings are Store Capital, by far, nearly $1,000 invested. My next largest holding is Federal Realty, which has $642 invested in it right now. And then I have Essex Property Trust, Realty Income, AT&T, Verizon Communications, Alliant Energy Corp, American Electric Power, Southern Company, Duke Energy, Gladstone Land, and Dominion Energy. Those are my top 12 holdings, I believe. And there's not a lot of change in those. Some of the utility companies are very similarly weighted, and so they might fluctuate day to day. But the top 10 companies are typically the top 10 companies from week to week. So to further review M1 Finance, I said that I take advantage of the auto invest feature. So anytime that I have over $25 invested, I have $25 in my cash balance, M1 will go ahead and auto invest that based off my target allocation. So it will invest in whatever is under allocated to try to bring the allocation back into balance. M1 will allow you to trade once a day, unlike say Robinhood or Webull or other apps. M1 restricts your trading window. If you have basic M1, you can only trade once a day in the morning window. If you have M1 Plus, you can trade once a day in the morning or afternoon window until you have a certain portfolio value. I believe it's $25,000, and then you can trade twice a day. Currently, although I have M1 Plus, I don't have enough invested, so I only get one window a day. But as a long-term dividend investor, I don't really see this as a hindrance. I don't see it as a restriction. I'm not too worried about the price within the day, whether I buy in the morning or in the evening. That doesn't concern me. I'm not too concerned with that daily price swing. I'm investing in these companies for 10, 20, 30 years. So whether I buy it in the morning or the evening and the price is slightly more at one point throughout the day than the other, that doesn't concern me. And I don't want to think about that, right? That's noise. What I'm trying to do is invest in these companies to dollar cost average into them. So it's fine that I only get to trade at certain times. And since M1 is auto investing for me, I don't have to take care of any of that. I might have mentioned that I have $100 going in every week, and that is to capture any dividends. Currently, my portfolio does not spin off enough dividends to hit that $25 balance I need to have them auto invested. So since I have that $100 coming in at the beginning of every week, whatever dividends I earned in the last week get invested along with that. And so that way they're not just sitting in cash for too long. I think that works really well for me. Even as I increase how much I invest in this portfolio, I'll probably still have it dollar cost averaged in weekly, even once my dividends start paying enough to be auto invested, which I'm hoping I will get to at around $30,000 investing. I'm hoping that my larger holdings then will yield enough dividend income that I'll hit that $25 mark and start having those reinvested. So that's a look at my dividend growth portfolio, a look at M1 and its features, and what I think about the platform. So let me know what you think. Comment down below, like and subscribe. I hope to start doing more of these videos. I hope to provide updates on my dividend growth portfolio so we can see this relatively new portfolio grow over time.